Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 19th of April. I'm Daniel Lam, your host for the podcast. I spent most of yesterday with my wife in the hospital as she was still recovering from childbirth the day before. I was keeping half an eye on the market action in Hong Kong China equities, and I saw the lackluster performance yesterday, despite the beat in first quarter GDP at 4.5% versus expectations at 4%. So if we look at the other key figures, retail sales rose by 10.6% last month from a year earlier, rising from the 3.5% growth in combined figures for January and February. So this was, of course, an important figure as consumption accounts for 2/3 of the Chinese GDP growth. Elsewhere, industrial production, which is a measure of the activities in manufacturing, mining, and utility sectors, rose by 3.9% in March year-on-year, up from an increase of 2.4% in January and February. So these were relative bright spots. But if you look at the fixed asset investment, it rose by just 5.1% in the first 3 months this year, year-on-year, down from a rise of 5.5% in the first 2 months of the year. So the key concerns here lies with the low price indices earlier, triggering warnings about the risk of deflation and inadequate demand, while pressure to create enough jobs continue to persist, especially amongst the youth. So for example, the jobless rate for the 16 to 24 age group remained at an elevated level of nearly 20% in March, up from 18% in February. So it appears that households and corporations still need supportive policies in order to repair their balance sheets after social order and consumption normalized post-reopening. Now let's go to the technicals. The Hang Seng Index dipped briefly below the 20,000 level to 19,886 at the end of last week. That level is now the key level of support for the index. On the upside, the Hang Seng Index needs to break above 21,006 in order to re-establish the upward momentum. There have been some encouraging signs in the index, with both Relative Strength Index and MACD turning stronger and more positive. Overall, we remain positive on Chinese equities on a 6 to 12 month horizon, as we believe the new government is keen to see continued economic recovery and would implement sufficient, but not excessive, amount of policy stimulus in order to achieve their growth targets. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.